The Federal Reserve has become more and more powerful over the past couple decades. I'm about to go over the major changes the Fed has made to increase its power and influence on the financial system. In 2008, the Fed started what is known as quantitative easing and quantitative tightening, which is basically when the Federal Reserve goes into the open market and buys and sells treasury bonds and or mortgage-backed securities. When the Fed buys bonds, it's known as quantitative easing, as buying bonds pushes interest rates lower, which makes it easier to get a loan and finance a new business, therefore stimulating the economy. When the Fed sells bonds, it's known as quantitative tightening, or QT for short. When the Fed sells bonds, it pushes interest rates higher, which makes it harder to get a loan and finance new business, therefore tampering economic activity and hurting the economy. In 2008, they started doing this to buy up distressed mortgage-backed securities, which saved many people from losing their homes, yes, but it also enriched many extremely rich individuals and incentivized risk-taking for years to come. The Fed also started to guarantee loans from Freddie Mac and Fannie Mae, which drove capital towards this newly established government organization as the Federal Housing Finance Agency announced it would take over both Freddie Mac and Fannie Mae. There wasn't a law passed which allowed the Fed to start buying bonds. They just did it. The Fed is a privately owned organization. They pretty much do what they want. Make sure you are subscribed to this channel, as I'll be breaking down who owns the Fed in my future videos. But the average inflation target is really where the Fed made its changes. And what I mean by that is, first off, I'll kind of preface this by letting you know what the Fed does. They have a dual mandate. So their first mandate is to maximize employment, which just means they're trying to create as many jobs as possible. The second mandate is to keep prices stable, meaning keep inflation at a reasonable rate. The historical inflation level, which has led to adequate growth and stable prices, is 2%. The Fed has targeted 2% inflation as a goal since the bank's inception, but in August of 2020, they made a subtle change to this historical 2% inflation target. They changed by saying the Federal Reserve will now target an average of 2% inflation rather than a stagnant 2% inflation rate. It's a slight change, I know, but they did so during a period of rapid inflation to rationalize higher interest rates. For example, in 2021, inflation was around 4 to 8% for most of the year. The Fed was able to say the mere fact that inflation is over 2% doesn't mean that we have to raise rates to slow the pace of inflation, as all we are looking for is an average of 2%. So now let's say the Fed was operating under the old way of doing things, which is that stagnant 2% rate. They would have to keep rates around 2% or below. The Fed would have had to raise rates in March of 2021 under their old standard. Instead, because they were targeting an average of 2% inflation, they were able to wait till March of 2022 when inflation was 6% higher than it was just a year before. So this average inflation rate really gives the Fed a bunch of leeway, and it really imposes a bunch of subjectivity into this standard. This new standard really makes it very hard for the public to understand what the Fed is trying to accomplish in terms of inflation. And Powell himself would say that policy is most effective when it's understood by the public. And I'll play that clip for you right now.
That policy is most effective when it is clearly understood by the public.
So my question is, why make it harder for the public to understand? This is my exact point. By making the inflation rate an average of 2%, you add subjectivity into the Fed's inflation goals, which by nature makes it less transparent and understandable to the public. Also, as we saw in 2021, the subjectivity of this average target was used to increase inflation to levels we have not seen since the 70s. Obviously, pandemic spending definitely contributed, but the Fed also made the mistake, and this change in their inflation target gave them the power to be objectively wrong through the subjectivity of this new standard. And just to give you some context, I'm going to play a quick clip from Powell in 2020 when he actually announced this new change.
Our new statement indicates that we will seek to achieve inflation that averages 2% over time. Therefore, following periods when inflation has been running below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. In seeking to achieve inflation that averages percent over time, we are not tying ourselves to a particular mathematical formula that defines the average. Thus, our approach could be viewed as a flexible form of average inflation targeting.
Also, the Fed and the FDIC has increased the subjectivity in the deposit coverage laws. So before I go into how the Fed flexed its muscle, let me establish one key point. The Federal Deposit Insurance Corporation, commonly known as the FDIC, insures depositors up to $250,000, meaning if you put your money at a bank and the bank goes under, you will receive up to $250,000 from the FDIC, meaning if you have millions of dollars at a bank that goes under, you could lose almost everything. You are only insured up to $250,000. I make this point because the Fed disregarded that standard and insured all depositors that were at the SVB failed bank. The FDIC, in tandem with the Fed, invoked a quote-unquote exception and bailed out the California bank's depositors. This gives the FDIC and the Fed power because now the president has been set that they can bail out any bank as they see fit, which once again adds subjectivity to laws. The more subjectivity, the more power for the Fed. Transparency and equal application of laws is what makes this country so awesome, and it really is what this country is built on. So it's really sad to see so much subjectivity being imposed on our laws. The issue with this subjectivity is now financial institutions may think if we can get on the Fed's good side, hey, maybe we'll be above the law as well. Also, bailing out SVB causes what is known as moral hazard, which is basically when there is no incentive to guard against massive risk taking. For example, if I'm another bank, I may say, hey, why not take risks? Worst case, if we make the wrong choices, the Fed will come in and save us, or at least our depositors will be saved. When you save depositors, there's no incentive for a person, an individual, a business, a depositor to vet their bank, as even if they go under, the Fed will save them for regardless of the amount, which really isn't fair because in most cases, the depositors that deposit their money at a risky bank are doing so for their own personal interest as they get some type of favorable savings rate or a lower interest rate on a loan from that bank. In SVB's case, the bank would give favorable loans to clients who deposited all their cash at the bank, meaning the depositors were being rewarded by taking the deposit risks through cheaper loans, which means they were being rewarded for their risk. But once it bit them in the ass, if you will, the bank obviously went under and the Fed came in and bailed them out anyway. So this riskless situation isn't fair for American people, and it's not fair for taxpayers, right? So if you're a logical person, you're not going to put your hard-earned money at a bank which doesn't deserve and isn't worthy of your capital because they have massive risk. You're not even going to worry about it because the Fed's going to bail you out anyway. The financial markets were shocked by the SVB failure, given it's a very popular bank for startup companies. The bank failed, though, due to poor risk management of their bond portfolio. According to the Fed and every market participant, every Wall Street firm that cared to comment on the situation would say it was SVB's fault. The bank made dumb choices, so why should the American taxpayer have to have their FDIC fund drawn down? Make sure you subscribe to this channel as I'm going to be doing longer form videos on the SVB collapse in the coming weeks. So I hope you enjoyed this video. We covered a lot. Thanks for watching.